Welcome to Views from the North, a Canadian rates and macro podcast. This week, I'm joined by Manmit Pandori, head of tactical and accrual trading at BMO Capital Markets. This week's episode is titled Room for Risk to Run. I'm Ben Reitzes, and you're listening to Views from the North. Each episode, I will be joined by members of BMO's FIC sales and trading team to bring you perspectives on the Canadian rates market and the macro economy. We strive to keep the show as interactive as possible by responding directly to questions submitted by our listeners and clients. We value your feedback, so please don't hesitate to reach out with any topics you'd like to hear about. I can be found on Bloomberg or via email at benjamin.reitzes@bmo.com. That's benjamin.reitzes@bmo.com. Your input is valued and greatly appreciated. Manmit, thanks for coming back on the show.
Thanks for having me.
It's an interesting time in markets. What we've seen over the past, pretty much since April, is a one-way ride in every risk asset. Stocks seemingly only go higher. Credit only goes tighter. Credit spreads generally are as tight as they've been, depending on the product, at least in over a decade in some cases, if not most cases. This comes despite ongoing uncertainty about trade, ongoing uncertainty about tariffs, unknowns on the U.S. data front, things seemingly okay on the activity front, but job numbers have been on the softer side. We don't get any data for a while now because the U.S. government's closed. And on the Canada side specifically, you could see cracks. We'll get the job numbers on Friday for Canada for September. If we get a third consecutive negative month, that is something you don't often see in Canada and would be I think, pretty big red flag for the Bank of Canada and really for the broader Canadian economy and we're headed. So I want to start on the credit side, on the risk asset side.
Sure.
How are you approaching markets now? Where do you see value? Is there any value? And even if there isn't, do you have a choice but to participate given that spreads just continue to grind tighter?
Yeah, I think a couple of things on that front. One, I would say overall, I think everything is rich. Everything's pretty expensive in general. There's pockets of niche asset classes that haven't participated in the rally, in the tightening, but you're starting to even see those sectors that are, generally maybe a little bit more illiquid, don't really come back as quickly as more of the liquid sectors do. Even those are tightening now. And so there's just seems to be a unlimited bid for credit assets and for risk assets. And that's obviously reflective in the valuations. I think the way that we're approaching it is it's a difficult one to not participate in. It feels like you're kind of setting up for this environment like a late 2019 where everything is generally pretty expensive, but there's a lot of cash still on the sidelines. Liquidity seems very abundant. Vol could not be lower. And so I think generally the grind in credit has been reflective of that. Our approach in terms of what we're trying to do now is more stay up in quality, where we can not try to overextend ourselves in terms of spread duration, going so far out the curve. Credit curves are extremely flat. And I think that that's reflective of just a grab for yield. And so you're just seeing people go further and further out the credit curve and not really get paid all that much for it.
The Provy curve's kind of steep. That would be one exception, just to be more Canada specific.
Yeah.
And one credit curve that I look at, but that would be an exception.
For sure. For us and in general, we're kind of more in this 0 to 15-year range of in assets that we invest for the bank. And so generally the long end stuff is just not as much of a fit for us. But to your point, I think where there's been a lot of supply, there's still some level of cautiousness that's priced into those spreads. But in general, everything is still pretty expensive. And so approach we've been taking is more let's continue to participate, let's ride this. But we've been, constantly thinking about tail events and how we hedge those tail events. And so, that means for us at least, buying some tail options, buying some options in stress events that at the moment are very, very cheap because vol is very low. And so, if you can buy that protection for some sort of event occurring or something breaking, because it feels like when everything is euphoria and everything is great, there's probably something looming that could drive us the other way. And so that's kind of been our approach, is to still try to participate in the rally, still be long credit, but really protect ourselves from, some sort of event type risk happening. Where we would lose in that scenario is if there was a steady grind of credit wider, but it just feels like that's kind of an unlikely event. If anything, it feels like we're on a grind tighter and then something breaking and driving us, materially wider from here. So that's kind of the way we're setting up.
Okay, so I got two questions.
Sure.
One, what do you think could break? What might be the drivers of that? What are you looking at? Is there anything specific? And two, and kind of related but different, how long can this go?
Yeah.
And from my perspective, like, way longer than anybody thinks is usually the answer.
Totally.
We have an environment where there is abundant liquidity already. Seemingly, there's still plenty of cash on the sidelines, which is always fascinating. And the Fed's going to be cutting more, almost certainly. And you're going to get a new Fed chair next year. And that will probably take a more dovish tack, I would think, which then means slower rates and more liquidity. And you have this exuberance, and whether it's rational or not at this point, I would say it's probably still on the rational side. Exuberance around AI and the potential there. If you go back to the 90s, Greenspan talked about irrational exuberance in 1996. And then we continued on for 3.5 more years. So there's lots of talk and fear about bubbles and things kind of moving up in a seemingly irrational manner. But we could be in the early stages of this, which I guess I like your strategy. I think that's probably the way to go. What are your views on that? Do you agree, disagree? Is the bubble already fully formed and we're going to explode in the next month, or where are we going?
Yeah, I mean, I guess as a bond guy, I should be very bearish on the world and say we are in a bubble and things are going to explode. I guess I would say it feels like there's always discussions around, hey, this is going to be the bubble that's going to burst and cause, the massive problem in credit and the economy. And like, I think prior to this, there was a huge focus on like commercial real estate portfolios in the US and how that was going to play out, and, all these vacancies and what that looks like. And I think that generally was, again, not saying that couldn't explode tomorrow, but I feel like we kind of passed by that kind of scenario. And then I think now with all of the AI focus of like, okay, how much bubble are we pricing into all of these stocks? Can they actually achieve all of this growth that they've been pricing in? I mean, it's yet to be seen. I find generally, just from more being a student of history, is generally anything that you think is on the horizon is likely not the scenario that is going to cause a problem, just because people generally, the stuff that's in front of them, protect themselves from that. And so like, I think even for our portfolio, when we're buying tails, we're kind of hedging these stress events. I think we're kind of setting up for some bubble to burst. Could I tell you what that looks like tomorrow? No, but I think there's a lot of different pockets of areas that could have problems. And look, like private credit's been a big focus now lately as well, what that kind of looks like, what valuations look like on people's books. So all of these things, I would say, are making it feel less and less every day that, hey, I should buy more credit and continue to find this grind. But I think to your point about how we think about how long this can last, look, you haven't really seen U.S. banks involved in credit at all, just with given like the rate uncertainty backdrop. If you get more certainty there and you get into a cutting cycle, there's a huge amount of pockets of cash that really could come back there. So I think there's definitely a backdrop right now where we just continue to grind tighter. And I think that we're kind of going to be stuck in that for a little while. Now, at some point, credit can only go so tight.
Are you sure? I mean, that was the famous last words. Like, we're at all-time tights for like CMB 10-year.
Yeah.
And like IG's not quite there, but I'm sure
close to it.
It's not that far.
Yeah.
So why can't it go through?
Yeah. And so, I think areas like that, again, like I was mentioning about tails, but other things that we're looking at is, the spread between high yield and IG is as tight as it's compressed unbelievably. So, seeing some reversal in that could be possible. So I think you're seeing the high quality stuff get to a floor, and it's slowly getting to that level. Like SSAs are a handful of basis points over treasuries. Could they get to zero? Sure. Could some of these very high quality like Apple, Amazon bonds like that get back to zero, or a handful of basis points? Sure. I think that's possible. Where I think you could get some real pain is if we go the other way and you get some of these high yield indexes, you get some of these lower rated bonds that have tightened to levels that probably shouldn't really be where they are. I think that there's like opportunities for those to widen quite a bit. Your other question was
potential catalysts. So that's at the end of the day, what's going to drive that widening, whether it be in high yield, broadly, whatever.
Sure.
I'm more of the view that like things will probably snap at some point.
Yeah.
Like it's not just going to be one thing. It'll probably be everything. And I agree with you. We don't grind wider. Like that's not. I don't remember living in that world. Yeah. We widen a ton and then we grind wider.
Exactly.
and then we slowly turn around over time.
Yeah.
But I don't know what that is. Like I have a couple ideas in my mind, but I don't see any of them coming in the very near future.
Yeah. And look, I think that prior to, from the financial crisis to COVID to all these times, I think there's been so many regulatory changes and structural changes to the market that it's harder for me to envision one pocket really causing a system-wide liquidity crunch or a system-wide kind of credit widening. Like in the past, I think you would have been more likely where, I think the way that the regulators have set things up now, how much access people have to liquidity, the way governments step into markets when there is, flashes of concern. I think there's just less likelihood of a systemic kind of issue causing a downfall like the whole kind of system. I think it's just less likely than it has been in the past. Now, I think one thing that could be a catalyst for widening stuff is really just seeing the economy, roll over. If you look at like unemployment in the US, the direction that we're seeing that go in, with that next year, you could see a lot of debt needs. I think, look, this year M&A was basically shut off because of tariffs and, the global uncertainty as to what was kind of going on there. And so people didn't really want to participate in any M&A. And then, you're seeing like debt deals finally start to come. Like Oracle had this massive $18 billion issuance. That's probably on the lighter side of what is needed to finance all of these data centers, tech, AI kind of focus. And so I think the amount of issuance that you could see next year on the debt side could be quite large. And, when you have valuations pricing into all of these things, are they going to fulfill kind of some of these higher valuations while the economy is in a tougher spot?
Okay.
And so I could see as kind of being a bit of a catalyst for just having a new price equilibrium kind of established. Because I do think this year, net supply in a lot of these sectors in credit over us is quite low. I know obviously everyone sees like there's been so much issuance and credit and all these things, but net supply is still, I think, negative still on the year. But so overall, you haven't seen a net supply shock to the system. And so I think if you get that while you're in a backdrop of the economy having challenges, that could be a catalyst for really setting a new price dynamic. But, if the Fed's cutting into that, maybe that's enough of an offset the other way to dispel this.
We also need to actually get data. So while the U.S. government's closed,
fair enough.
We don't really know what's going on. But I mean, leaving that aside, I guess some of the private numbers do suggest kind of some softening on the job front. It is possible, and I don't necessarily have strong conviction here, but it is possible that the sharp slowdown / reversal in population growth in the U.S. with them shipping people out is having a material impact on the job numbers. And I mean, you can see that in Canada, for example. So like when population growth was running rampant here, job growth was wickedly high, and the unemployment rate was kind of rising anyways. So we might be seeing the opposite of that in the U.S. Maybe. I'm just tossing it out there. It could just be weakness. Totally possible. And I've been kind of bearish on the U.S., but I think I'm starting to change my tune. Maybe too late here. We'll see. One thing that concerns me, I guess, and you didn't go there, is rates. I mean, treasuries, real rates, whatever rate mark you want to look at, the risk-free rate effectively. The U.S. government's still borrowing lots, 6% of GDP. The tariffs will help. That'll be a few $100 billion to carve out for the deficit. But you're still looking at multiple percent of GDP with really no timeline for that to narrow in any meaningful way. And you also have concerns about independence in the Fed, and that only ramps up next year when we get a new Fed chair. We'll see who that is. Maybe all of this is for naught, and we don't need to worry. But it's out there for now. I guess my concern is, and we've seen the curve steepen a lot. I guess my concern is that trend continues, and we get globally steeper curves, globally higher real rates, and at some point, no matter how fast these companies are growing on the tech side, higher real rates will have an impact, and valuations then matter and probably need to contract to some extent. And so, like, for me, that's one thing I feel like that could really cause everything to kind of go pear-shaped. It doesn't seem like that's where we are at the moment, that peak fear. I mean, we saw it it was like 2 months-ish when the market was really freaked out about deficits and inflation and the Fed and all that. And then it's kind of gone away, which is weird. I don't really know what happened, but it's effectively dissipated, I guess, with inflation coming back a bit. That's helped, and tariffs not being as bad. But I don't think that risk is gone by any means, even if the market doesn't seem to care for now. Like, do you see that coming back? I think it's a 2026 story, but what are your thoughts?
Yeah, look, I think that for a couple of years, we obviously went through this period where, no one was even looking at a budget, trying to
just print money, baby.
Just print unlimited money.
What can go wrong?
And I think obviously inflation was reflective of that. Look, I feel like we've kind of shifted a little bit away from inflation in terms of like the market's focus on it. I think the tariffs haven't really come through the data yet. And I keep saying yet because I think everyone is anticipating that there would be a much larger impact on inflation from the tariffs. I think, look, I'm not saying that risk has gone to zero, but clearly a lot of the rhetoric and the headlines that came out of all of the tariff announcements was really just posturing and had announcements that the US government wanted to make and that kind of thing versus it being how it's actually implemented. And, it hasn't really come through. Maybe there was all more brilliant negotiating tactics from their end than anything else. But I think because inflation has kind of not been as big of a concern, I think that the focus on deficits has kind of gone away a little bit, but I do think at some point that has to come back, right? And because it's like this money has to go somewhere. Similar to what I was saying around valuations and M&A and, companies buying very, very expensive companies because, if you look at how much even the Mag 7 spends on CapEx and just M&A, it's unbelievable, how much they've spent and they'll continue to spend. And so I think in the backdrop of all of those things, look, like from a rates side of things, I do think, we're set up for steeper curves. I just think that that's here for the long run. Like the Fed can only really control the front end, and I don't think they have really any control of the long end. And so, to your point around real rates and all those things they're very telling of, especially in more developed economies that can't really support those real rates. Like we just don't have the growth to be able to actually do that. And so, look, I think we're set up for steeper curves. If you asked me like what our view is on rates in general, just directionally, we're set up fairly neutral here. We're in steepeners. Our book is kind of hedged within a steepening bias, but I think that's all you can really have conviction in right now. Like I think it's hard to say because we're kind of counterbalancing all these things we're talking about: a Fed cutting, economy having a difficult time. I think I saw something that like job openings to unemployed is like the first time that it's below 1 in the US now. And so you're getting to a more difficult backdrop from an economic perspective, but it's not like these governments are going to not print money. Yeah. And so, I think that just means you have steeper curves. For rates in general, I think it's hard to kind of have a direction in 5s and 10s here because you're kind of getting pulled down from more of a cutting cycle, but then maybe getting pulled higher because of the deficit side of things. So maybe I'm not the perfect guy to have this week on being like, hey, just get long 30-year bonds or something. We're set up for fairly neutral here, because I do think, look, in terms of the path we have priced in today, it's probably about right. Like, you get a couple cuts priced in for the rest of this year, some cuts priced in next year. It feels like we're kind of priced in a little bit too much to perfection of, us gliding through everything without having any issues. So there's that.
Okay.
Yeah.
That makes sense. I mean, not sure the governments are printing money at the moment.
Sure.
They're printing a lot of debt.
Yeah.
I will say that. And maybe eventually that ends up in on the money side if the Fed continues to cut rates next year. I guess like that, for me, that's it. Like the combination of let's go with not fiscally responsible government, and that's globally, combined with lower rates, combined with strong asset markets. I mean, something there doesn't quite fit together. I don't think. At some point something will break. Yeah. We'll see when that is. It feels like the U.S. could go for a while yet. Like, you already have softness at the lower end of the income spectrum.
Yeah.
But the high end's doing well, and wealth continues to push higher. And as long as that happens, you kind of get this positive feedback loop that's self-perpetuating. And so something there has to change, I guess, for that cycle to really weaken on the growth side in the U.S. Even if employment is on the soft side, I think the stat is 50% of U.S. consumption's done by 10% of the households at the moment. Yeah. The top 10%. And so
I thought it was even high. It might be even higher.
No, there you go.
Yeah.
And so, like, as long as that dynamic holds, they're probably okay.
Yeah.
Even if you get bad job numbers. But what the bad job numbers do is they just push rates lower.
Yeah.
Because they give the Fed an excuse to cut, and then you get this more, and then you get more liquidity, and then asset prices go higher, and then that positive feedback loop just perpetuates. And so, like, that's I guess where I just think things keep going. Like, I wrote a piece for Economics 2 weeks ago and about a melt up, and it feels like I think we're still going to get that. Like, things are strong now, but just you wait. I've seen this movie before, and things go parabolic at some point.
Totally.
Or something that looks like that. And then it's like, whoa, when everyone's all excited. Now there's still some pockets of resistance around, like, metals. Oh, I don't know. Things are expensive. Tech, I don't know. It's expensive. When everyone's like, no, this is it. Let's go. Everybody in the pool.
Yeah.
Then it's time to probably be a little bit more concerned. It doesn't seem like we're there quite yet. I agree. Even if prices have already gone up a ton.
And look, like, I think more of what we're talking about here is probably maybe less scientific and more around behavior.
100%.
But I think that, like, there's a lot of apathy kind of priced into the market. Like, you go and talk, even with us, we have a lot of connectivity on the street, and you talk to various pockets of different dealers or clients, and everyone is like, oh, I don't know why anything would go wrong. Everything seems fine. And so, like, I think in general, when you get into these types of environments where I think people are, like, searching for any reason for something to go bad, and they can't really find one, generally that's when you get to some point where something is going to probably break.
Listen, when all those people turn optimistic and they're not looking for any more bad things, that's when it will break.
Yeah.
So I don't think that's coming now. I think that's I can't see it before next year personally, but I mean, who knows? That's the whole point. Is unknown unknowns is always what gets us.
And I think that's where we are in terms of how we're setting ourselves up, is try to continue to participate in this and, stay invested at least in names and stories and themes we continue to like, and then just protect ourselves from, some large event style things occurring. And look, like, in general, for your listeners who manage money, a lot of that kind of protection is fairly cheap at the moment, just because vol has come down to where it is. There, in general, sometimes even in this environment, you might see like leverage leaving the system because things are too expensive to be able to afford that leverage. But liquidity in general is so abundant. Banks have, like, repo levels haven't really ticked up. You're seeing some equity finance levels start to tick up kind of going into year end, but that
happened last year too.
Yeah. And that feels a little bit more technical. Like, I think like in years past, even, for example, like, sorry to keep jumping over the places, but you look at, like, SOFR Fed funds. Like, SOFR Fed funds is implying that there's a lot of liquidity problems in terms of where SOFR is setting. But there's ample room for people to go and get leverage. And even on the equity financing side, I think a lot of those things have been more technical in nature than they have been a reflection of, well, funding is tight and those things. So I think when you get into these environments where all the more technical backdrops are very ample and just easy to be accessed in terms of like vol being low, liquidity being high, supply not being crazy positive, all of those things just kind of lead to this kind of more grind tighter type of environment. And I think the difficulty if you're not participating in it is that this could last for 2 years.
Yep.
And we could be having this exact same conversation 20 beeps tighter from here.
I think we might in 6 months.
In a year or in 6 months or something. And I think that's a totally realistic path. And I think another path could be like maybe there's some, massive widening, some event type thing that happens and you want to protect yourself from that. The path of us grinding wider into, just a very orderly type of environment just feels like the least likely out of those three.
All right. Yeah. I'm going to leave it there for this week.
Thanks, Ben.
Manmit, thanks for coming on.
Yeah, thanks for having me.
Thanks for listening to Views from the North, a Canadian rates and macro podcast. I hope you'll join me again for another episode.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.